Let's welcome on board Sadanand Dhume, the resident fellow, American Enterprise Institute, joining in on the show right now. Mr. Dhume, so good to have you today on ET Now. And I want to just first go back a month ago when Trump announced the reciprocal tariff across. There were multiple headwinds, even war between Russia and Ukraine, Israel and Gaza. And on the other hand, you've got the tariff situation today. It's easing. Peace talks are on, although we're still in the 90-day period from the US. Do you think these headwinds are behind us?
No, not really. I mean, I think everything is, very much still up in the air. We're not clear how the world is going to look at the end of the 90-day suspension of tariffs. And it's also not clear what shape the US-China trade relationship is going to take. And that obviously has very large implications for India, because depending on at what level the tariffs end up on China, that's going to make a big difference to firms, whether, that are thinking of relocating some of their manufacturing to India. So I think it's fair to say that the shock to the system has been, to the international trade system has been postponed. But I think it would be overly optimistic to claim that the headwinds have disappeared. We're still in a period of great uncertainty in the global economy.
So US now is sitting on a debt of 36 trillion, representing 120% of the debt to GDP. US sovereign bond rating also has been downgraded recently by Moody's. Help us understand how this will impact impact due to the rising debt levels, and what is the risk associated with such high debt, and does this take away some advantage that Mr. Trump has been negotiating for higher tariffs?
Look, the US still has many cards, right? It's by far the world's largest market. It is a huge market for all export-driven economies. It has the world's currency reserve. And, there may be sort of, some movement around the edges to change that, but that's not something that would happen very, very easily. And obviously, it would be much better if the debt level was lower. But I don't think that 120% is, that daunting for a country that has the world's reserve currency and has such an enormous economy. So the US has a lot of cards in this, but that doesn't mean that it's completely, immune from the rest of the world. My own belief is that trade is mutually beneficial, and that the US should seek to maximize its trade benefits without being overly focused on tariffs. Now, obviously, this is not what President Trump's policies are, but I don't think that the Trump administration goes into these negotiations thinking that they have a weak hand. In fact, they go into negotiations thinking that they have a very strong hand.
Right. There's also a case for slowdown in the US. On one hand, you've got Trump, who's being very vocal about the need of rate cuts, and the other hand, Fed chair is firm on the wait and watch stance. What are your thoughts? And do you think one would see rate cuts coming up in the upcoming Fed meets, perhaps?
Look, I mean, I don't think this is this is a little bit outside of my area of expertise in terms of sort of, whether or not they should do rate cuts. What I will say is that, this is a very important moment for the US in terms of maintaining the credibility of the Federal Reserve as an independent central bank, right? I mean, one of the reasons that the US has been the safe harbor for the world, really, for so many years, is that people really respect the quality of the independent institutions such as the central bank. So my own guess is that the central bank is going to continue to be independent. Mr. Trump can, tweet or Truth Social or whatever you call it. But I don't think that central bank rates in America are going to be set based on what he's tweeting. I think the central bank rates are going to be set based on the Federal Reserve's assessment of the US economy. Whether they should raise it or whether they should cut it is really something that's, a little bit beyond my domain, so I wouldn't comment on that.
Just want to wait for things to settle now. Recently, reports highlighted that the US weights in MSCI countries and world index have come down, with as high as 67% in December 24. With equity funds flowing out of US, do you think countries like India could actually see inflows?
Look, I think India has, had this story for a long time where India has been, poised for great success. But right now, I think what India really ought to be, focusing on is the elements of its own economy that it can control. India is not in a position to really control what the US does with tariffs. India is not in a position to control the parameters or the contours of a potential US-China trade deal. We just don't know what's going to happen, right? Where are these tariffs going to land? What's the US going to do in terms of encouraging inward investment and so on? But what India can definitely do is signal its own commitment to reforms, which have really slowed down, right? So if India could sort of, really put some juice back into its own reforms program, do some serious deregulation, do some serious privatization, show some sort of, commitment to deepening the role of markets in the Indian economy, I think that's something that investors, of all kinds, will take into account. Particularly since India, has a good news story both in terms of its youthful demographics and in terms of the fact that it's become the fifth largest economy in the world at market exchange rates and is on track to being the third largest economy. So, that would be my advice.
Right. So with this, now there are concerns rising in the bond markets as well. US bond yields rising because of poor demand. India-US yield, the spread has been narrowing. Japanese bond markets, the yields have also risen very sharply there. In fact, earlier we've seen Japanese bond yield unwinding, and that sort of caused market turbulence as well. Do you see any of such event now?
So look, I can't say about the future, but it's certainly true that, according to several reports, that it was a weakening of the bond markets that really made President Trump put in place this 90-day pause in the first place, right? There was a worry that not only had the stock market taken a beating, but that the bond markets were too, which was quite unusual. And I think it was that dual softening that did lead to pause. So very clearly, people at the very top of the U.S. administration do have some concerns about, how things could turn out. So that's certainly something that's on people's radar screens.
And what are your thoughts on US dollar? Some of the experts shared the concern about overvalued currency to hit 109. Do you think the dollar can depreciate further?
I don't know. I mean, at this point, whatever movement we're seeing on the dollar is organic, right? It's not like we're seeing some equivalent of the Plaza Accord where there was a, deliberately a policy-driven strengthening of the yen to sort of put the two the Japanese and the U.S. Trading economy more in balance. So this is organic. I think a lot of this is just being driven by, frankly, by pure uncertainty. We don't know which way the world is headed. We don't really know how firmly committed Mr. Trump is to, the much higher tariffs that he's proposed in his second term and so on. So I think there's a lot of uncertainty, and because of that uncertainty, that's affecting the dollar. But if you look at the bigger picture, the dollar is the reserve currency of the world. The U.S. is the largest and the most liquid and most accessible economy in the world. So barring some kinds of huge shocks, I don't see that changing dramatically. Certainly not in the near term.
All right, Mr. Dhume, with this, we let you go on that. Thank you so much for taking the time out and speaking with us this morning.
If you like this video, then like, share and subscribe to ET Now.